Hey everyone, welcome back to another episode of Who Moved My Investments. Today, we're diving into the world of rate cuts and opportunities they bring for our investors. Joining us is our resident expert, Robin. Now before we get started, let's just say this. If you're still just T-billing and chilling, well, you might be missing out on some serious growth potential.
Well, it's true. The rate cut cycle has begun, and there are some smart moves investors can make right now.
So what does it truly mean for investors? Is it like just another financial jargon thing, or should we really pay close attention to what's happening?
Investors have been looking for good returns from safe options such as fixed deposits, high-yielding saving accounts, and T-bills. From late 2023, many have started to expect moderate rate cuts in 2024, and the US Fed surprised everyone with an aggressive 50 basis points or 0.5% cut recently. The European Central Bank or ECB also made a second rate cut to support the Eurozone economy. In Singapore, the yield on the 6-month T-bill has reacted to these cuts with the latest auction offering cut-off yield of 3.06%. Looking further down, expectations are for yields to fall further.
Interesting. I also know that some people are concerned where else to put their monies, especially with declining rates on T-bills and savings accounts. What do you think?
That's a total valid concern. While rate cuts can be good news for the economy, they often mean lower returns on savings accounts, T-bills, etc. This is why having a solid investment strategy is key. Now, there are opportunities to help your money grow, even when interest rates are doing a little dance. I wanted to also bring in bonds into the picture as they are an important piece. Our bond yields are basically what you earn from holding a bond. The Federal Reserve rates act as a good benchmark since the chance of the US government defaulting is very low. Now, typically, when interest rates dip, bond yields follow suit. Now, of course, they are also influenced by other factors such as economic growth and expectations for future rates. As we expect interest rates to ease and bond yields to drop, it's a great time to think about unlocking those current bond yields and exploring other assets that might shine in this new landscape. Exciting times ahead.
Just like that old adage, don't put all your eggs in one basket. But in this case, it's a little bit more like don't keep all your money in just one savings account. So what are some of the smart moves, Robin, you think, for our investors, especially those who are just starting out?
Well, T-bills are considered to be very low risk since they are backed by the Singapore government and are a safe harbor for investors who are very risk averse. That said, fixed income is still a great option, even with these rate cuts. We've been recommending a barbell strategy, which involves diversifying your fixed income investments through high-quality short-term bonds and long-term bonds.
So a balance between short-term and long-term investments, just like, having appetizers and also going straight for dessert, isn't it?
I like your analogy. But similar to your diet, you work on a balanced approach. Right now, it's a great time to think about short-term bonds because they provide a good sense of securities with your returns that help you dodge the risks of interest rate changes. For everyday investors, sticking to a short duration bond is a smart move as they are less sensitive to interest rates movements and provide reliable yields in the near term. Now, but here's the catch. Many of these bonds usually require hefty starting investments of 250,000 Singapore dollars, which can be a stretch for most folks. But don't worry, you can still get into the action through options like funds that focus on high-quality bonds, such as the DBS CIO Liquid Plus Fund, or managed portfolios like the Save Up portfolio, which you can start with just 100 Singapore dollars.
What else should investors be looking at?
Well, we see opportunities in dividend-paying equities. We also see great potential in REITs. Think of them as being landlords for a portfolio of real estate assets. Not only do they offer attractive dividend yields, but they are the prime beneficiaries of interest rate cuts as financing costs are now lower, which can enhance profitability. Now, this could lead to higher distributions to investors, making REITs more attractive as income-generating investments. Singapore REITs in particular yield around 5 to 6% annually and are amongst the largest in Asia, with over 39 options in sectors such as logistics, industrials, and retail. For those who are looking to dive in, you can easily invest in S-REITs by setting up a regular savings plan on Invest Saver. It is a great way to enjoy steady returns.
So we're talking about investments and can give you a good return or give you a good sense of security as well. That's pretty sweet.
You're catching on. And last but not least, ASEAN is a region we are really excited about. This region has good economic prospects, and the China Plus One strategy is creating a lot of opportunities too.
Our region is definitely on the rise, but just for my benefit and maybe a few of the viewers out there, what do you mean China Plus One strategy?
Now, companies are diversifying their supply chains, moving some of their production away from China and into other countries in the region. And this is creating a lot of opportunities for businesses and investors in ASEAN.
So it's like businesses are saying, we want to diversify where we produce our goods.
Exactly. And ASEAN is becoming a very attractive alternative because of its strong economic growth, skilled labor force, and strategic location. Plus, the region will benefit from Fed's easing policies, which means the sectors sensitive to interest rates are going to bounce back after a tough time. Now, with things shifting in their favor, high dividend yielding stocks are expected to gain flows. We can expect a nice recovery in property, consumer sectors, highly leveraged sectors will also feel some relief too.
I just checked my Asia DigiPortfolio on digibank and I actually like what I'm seeing. There's some greens that I'm very positive about. So any immediate actions you think our viewers can take?
So it's important to remember that markets can fluctuate and to stay invested through dollar cost averaging. As a T-bill door closes, another opens. If you are looking for some potential actions, consider reviewing your portfolio and making sure you are appropriately diversified. Explore short-term, high-quality bonds and keep an eye out for opportunities in emerging markets like ASEAN.
Thanks, Robin. I've really learned so much today, and unfortunately, we don't have a lot of time. So, guys, it seems like the time to T-bill and chill might just be over.
So it's less bills and more bonds. Thanks for watching and see you next time. Bye. T-bill and chill? Invest smarter. Click on the link below to find out more.